It's been a while since we've had best-selling author Nomi Prins on. She wrote It Takes a Pillage. She also wrote this, another best-selling book, All the President's Bankers, had all kinds of great stories in it. And also, the latest book is Collusion. It's been out for a while. She's working on a new book, but let me tell you, it kind of dovetails in with this book, and I just want to read the last couple of sentences in this book. It only takes one domino to fall to wipe them all out. It will again begin with banks crippled the markets and devastate the global economy. Yet the inevitable financial crash these conjures will not be blamed or monitored. The world economy remains imperiled, an opportunistic game to the central banks, a field day for speculators, a hazard for populations. She predicted in this book there'd be another crisis. And there is. And I'm talking about Nomi Prins. Nomi Prins, thanks for joining us today on USAWatchdog.com.
Thank you so much. Pleasure to be back.
This is really cool. You're working on your next book. You don't have a title, but it picks up at the end of Collusion, where you predicted there's gonna be another crisis. So tell us where we are in this next crisis.
So we're not actually at all of it. Let's put it that way. We're not done with the next crisis that came from the coronavirus pandemic and all of that, because we were already in crisis mode, as I mentioned at the end of my last book, going into 2019. So what did we see at the end of 2019? We saw this pivot, what I call phase 2, from central banks being sort of on hold. The Fed had been actually in tightening mode through the beginning of 2019, actually into 2018, and then they pivoted. And then the rest of the central banks in the world, unlike last crisis, also pivoted back to easing. So by the time we got to the end of 2019, 60% of the world's central banks, and that includes emerging markets, that includes G7, that includes People's Bank of China, had pivoted to easing mode. Now, of course, it was led by the Fed in September 2019. The Fed had sort of tightened a little bit its book into August of 2019. It had gone down from $4.5 trillion worth of assets on their book at the height of the financial crisis post-period to $3.7 trillion in August. Come September, come October, November, December, and the Fed's producing repo operations. Those are short-term lending operations that are supposed to be the purview of the banks and their customer corporate clients. Fed's not supposed to get involved, but it did to calibrate that. It had all sorts of excuses. It's not QE, but it was. And the Fed's book blew up to $4.1 trillion by just the end of 2019. In tandem, economies were already faltering. They weren't as rosy as they were promised to be. They were faltering. They were slowing. So you have the Fed and other central banks easing. You have economies slowing, and the markets were still going up. So those three things together sort of didn't jive, and they created this opportunity, this situation, I should say, for that next crisis that I talked about at the end of my last book. Put the fourth factor into that, the immense amount of debt at the end of 2019 for the world was 3 times GDP. That meant for every dollar borrowed, that meant for every $3 borrowed, only $1 of productive economic activity occurred. That's what we started 2020 with. You throw a pandemic into that, a shutdown, a stoppage, global uncertainty from a health, from a financial, from an economic, from a political, from a trade perspective, and you have the makings of where we're at now, which is a longer term drawn out financial and economic crisis.
How does this, everybody wants to know how in the world is this going to end? How does this end? We just got all this money and we're never going to pay it back, right? Nobody's intending to pay this back, right?
We are not going to pay back the debt that, and this is global. No one's even trying to consider the possibility of paying back the debt that's been created. And let's think about why that debt's been created. It's not just because the economy slowed down. That's one reason. That's kind of an excusatory reason, because the reality is that monetary policy, the Fed on steroids, other central banks on steroids, emerging markets popping in throughout the world, in a larger number, in a larger magnitude, and in faster mode than they had in the wake of the financial crisis of 2008, meant that all of this new debt that's being created is even cheaper than it was before going into the 2008 crisis. So more debt created more cheaply means less incentive to pay it back, more incentive to push it down the road and grow it. So you got this like really big, snowball coming down this like really, really high mountain, and it's growing and it's getting bigger and it's getting bigger. And at the same time, you have avalanches of that very mountain, say the mountain's the actual economy, sort of falling down as the snowball's rolling down onto the bottom, which is the Main Street economy. The Main Street economy itself, that foundation is shaky. It was shaky going into this period. GDP in the U.S. had fallen to 2% for annualized 2019 from a predicted 3% value. The UK was anemic, Japan was anemic, the EU was anemic, and emerging market countries were even worse than that. This is going into this period. So you add all those visuals together, which are representatives of monetary and financial and economic policy, and governments that really just don't even know how to plan strategically to even deal with this, because they have this like perverse incentive to continue to borrowing because it's so cheap. And so how does that end? It ends really, unfortunately, with the foundation, which is us, which is the Main Street economy, basically being sort of crashed through by both that snowball that's been growing as well as the avalanche of the mountain. And that could be a permanent, or at least a multi-decade problem, not just a few years problem. We'll see the markets go up. We'll see certain asset prices go up because there's cheap money in the market. It needs to go somewhere. There's money on the sides. It wants to go somewhere. Returns want to be made. But that foundation is even shakier today than it was before the financial crisis of 2008.
What does this look like to the guy on the street? What's it going to look like to him or her or their families?
So it's going to create for the near term a real high level of uncertainty. Now we have the uncertainty from the health ramifications of the virus, from whether things reopen and then close, and reopen and then close. If you remember how sort of trade wars was developing in the past couple of years, the markets and the economies and the real economies and sort of waterfall of the small business person who uses products from the larger business person who uses products from the global economy, all of that sort of chain was kind of already disintegrating. And when you stop pieces of that chain, which is what we have now, the person on the street has a lot more uncertainty. And one of the ways we've seen that manifest, aside from the tremendous amount of job losses and the high unemployment rate, which in a real terms is even higher than what we're being shown by the Bureau of Labor Statistics, is that we actually have a situation where people have been saving more even though they've potentially been making less. So the savings rate went up to 33% in April from just 8% in February. Part of that's because people were on lockdown or shutdown, and so they didn't have as many avenues to spend. But if you think about it, when uncertainty is prevalent and people aren't spending partly because of lockdown, it's not just because of lockdown, it's because they're trying to conserve and protect because of that uncertainty. And those chain reactions from that small restaurant on your favorite corner having to close because it just doesn't have enough customers to warrant sort of paying for the utility of operating it, for the lights, for the water, for the AC, for whatever it might be. And so those problems, when that restaurant closes, then the food suppliers to that restaurant have like one less, and multiply this by cities and towns and states throughout the country and then countries throughout the world. You have this bottom-up problem that also has a top-down situation problem as well. And so that's what it looks like. So if I'm an average person, I'm thinking, okay, well, how do I reset my connection to the economy, whether it's my local economy or whether it's the stuff I purchase or the services that I use on a more than local level. And I have to make choices, right? And I think what it's doing is making people choose to pivot to the businesses that have been able to kind of develop ways of dealing with this crisis. So the ones that are providing, say, restaurants, different kinds of takeout options or different kinds of sit-down options or different kinds of safety options where people feel they can come back, be comfortable, and move on. Same thing with technological options. Same thing with any form of movement, any form of energy situation. People are just making different choices, and they're also conserving because of that uncertainty. It's Great Depression times. Then it was money under a mattress. Now it's money in bank accounts. The biggest banks in this country have accepted over $2 trillion worth of deposits since this pandemic occurred. That's just U.S. banks. Some of that's because of businesses drawing down on their credit. Some of that's because of loans that people took out from PPP, but that's a very small part. The rest is depositors just saving money as they can that's coming in. Ultimately, that money will need to go somewhere, but a large chunk of it will and should remain in savings. And that's what we're going to look like, more of a conservative, from a savings and planning standpoint, society for the foreseeable future.
You have a name for this. What is the name that you're giving this next stage? You told me in the pre-interview. Let's talk about that.
Yeah, so I call it a permanent distortion, and permanence. That's bold. I think permanent is a word that I don't believe I have used in prior books, but I'm using it now as I consider how this is all going to go down. And the reason for that is because the disconnect between financial assets, between the equity markets, between the debt markets, and between the real economy, which wasn't great, which wasn't small whatsoever at all after the financial crisis of 2008, has become massive. If we think about how devastated equity markets were, for example, in the first quarter this year as the pandemic was unfolding, and then we look at how quickly and how largely they resurrected themselves on the back of central bank money and the expectation that central bank money was going to be there, as Federal Reserve Chairman Jerome Powell has said many times, with no limit. They'll be there with whatever they can for as long as they can. I mean, all this sort of Mario Draghi, ECB, no limit kind of talk that was happening a number of years ago is the Fed's policy and its central bank's policies around the world to the extent that they can. Some countries, and this is where the disconnect happens outside the U.S., like emerging market countries, have copied the Fed. They have brought down their rates substantially, not to zero like the Fed has, because they can't, because more inflation occurs in those countries from real prices, from fuel, from food, from things that are necessary to people, than in the United States. We have sort of more float around all of that. It kind of gets put in the ether. But they're going to have massive problems. Because they brought rates down so low, and it's going to ultimately create inflation in their countries before it creates inflation in our country. Where our country has inflation is in the markets. So if we look at the fact that the economy itself has so many jobs that were lost, has unemployment figures that don't really represent the uncertainty of employment going forward, of opportunities going forward, and so much debt from the standpoint of public debt and new corporate debt that's been taken on just in the last couple of months because of this expectation the Fed's going to be there, rates are going to be cheap forever. All of that is really a permanent disconnect and permanent distortion from financial assets to the real economy. And the problem with it, and why it will perpetuate itself, which is a little bit different from the last crisis around, where there was already disconnect and more inequality in populations relative to the zoom in financial assets the upticks, is that there's going to be a sort of endless supply of artificial stimulation, whereas into markets. We knew it was large last time. But there were some questions throughout the markets, throughout investors, throughout speculators, who really drive up financial asset prices as to whether or not it could really be enough. It could really continue forever. And I think what we've seen in the last couple months with the Fed's balance sheet, for example, almost doubling in 19 days relative to 9 months, where it took to get up to similar levels last time, and it's not ending. Bill Dudley, who was the president of the New York Fed, which is like the closest Fed, it's the Wall Street Fed, really, to in the Federal Reserve System. He was also a former partner at Goldman Sachs, where I used to work. We at some point, we crossed paths back in the day. He even said in a recent Bloomberg article, the Fed's supposed to get to $10 trillion, which I've actually been saying for the past few months. He came in and said it as well recently. That's massive. And that's not going away anytime soon. That's not being unwound anytime soon. That becomes a permanent lift to financial assets, and that idea, that snowball effect continuing to grow, if we consider the snowball of financial assets, which is not going away. So in the wake of that, less real capital gets used for infrastructure, for research and development, for growth, for retooling the economy and people's jobs into this new period of post-COVID, more technological requirements from people, and the money doesn't get used necessarily for that, and that's in addition to the problems with, places like restaurants and airlines and travel and leisure and all of those things, which will take a while to come back to anything near what they were before, and that doesn't even count whether or not there's a real resurgence of this virus or another one or something else external that hits the system.
Why gold? Why are so many countries, sovereigns, hedge funds, wealthy people, why are they all clamoring for gold, physical gold?
Yeah, because there's in the wake of all of this creation of basically electronic fake capital, that's going to elevate financial on paper assets, right? Like stocks, like bonds. There's a desire for permanence, right? When there's any kind of uncertainty, we saw this in the wake of the financial crisis of 2008. There is a drive, a desire to have some sort of permanence, a storage of wealth and an increase of wealth over time, that can be, and physical gold as the most sort of prevalent commodity exemplifying permanence. Gold is a thing, relative to a stock, a certificate, an option, a future, right? And because of that, it has a permanence element to it that's more important now than it's ever been before as well. Now, so far, gold has only kind of rallied from about $1,400 an ounce last year to about $1,800. But that is, I think, just the beginning of where gold could go if this environment continues. Gold tends to also track the expansion of the Fed's balance sheet. So we saw a kind of bump up in gold in the initial expansion of the Fed's balance sheet from around that $4-ish trillion, which is where it kind of began the year, which was the height of where it had been after the financial crisis of 2008 to 7.1 trillion where it is now, and it will go further and further. So in that first bump, we saw gold rally, and we saw people wanting to both hedge themselves for any type of financial asset inflation. I don't think it's real inflation. Other people do. I think now to date it's more to hedge against financial asset inflation, and also to have that commodity, that asset class that pervades a sense of permanence relative to paper money, electronically created money, and debt. And so that's where I think gold now is in more of a position to continue to increase in value. And also because there was an economic slowdown, there was a slowdown in terms of mining that gold as well, or mining new gold. And so you had a sort of dip in supply just because of a physical sort of slowdown relative to the supply that was actually out there. And so that also gave an initial bid to gold. But as the Fed continues to grow its balance sheet, as we have wobbles, and this permanent distortion continues to happen between the market and the real economy that central banks will try to weave themselves into, I think that's going to continue. I think the same thing of silver, which has not had that same rally. Of course, in the wake of 2008's crisis, it took a little bit, but silver did get up to $50. And I think that right now, where it is around below 18, I think it will have upside as well. And I'm talking about the real assets, some of which are replicated by ETFs and futures, et cetera, in the market. But the real assets, that real permanent value of them, is going to continue to be in demand.
Wow. When do we get the actual inflation? Martin Armstrong came on and said, I know they're blowing their balance sheet up, the Fed, but the capital destruction is 20 or 30 times. These restaurants are going out of business. Businesses are going out of business. You're getting this big capital destruction. The inflation's coming, but later. What's your view on when does the inflation come? I mean, the amount of money. There's the covert side, which I know you don't really cover with Dr. Mark Skidmore, 21 trillion, and the churn of the treasury market is something like 90 trillion. It's just eye-popping. I mean, your head wants to explode like this was a cartoon. But when do we get the real inflation? I mean, there's tons of money printing. That's a fact. When do we get it?
Well, I'll say this now, and I've been saying this the last crisis and for years, is the inflation that we get doesn't necessarily look like the old inflation monitors. In that last time around, what I call phase one, or the period up through the middle of 2019 and the post-2008 period, where phase two is from mid-2019 on, in terms of how I characterize it in this world, is that financial assets did inflate. Debt did inflate. The prices of certain necessities, like healthcare, and certain things that help people economically from a future perspective, like education, those things did inflate. And so we had elements of the economy that weren't necessarily items, like fuel, like oil prices, that did inflate, whereas those didn't. And I think that's what we're going to see and what we are seeing. Again, so I think when we talk about inflation now, we have to think about it in different terms, because there's this extra factor, which is the Feds and other major central banks sort of a permanent step in this field of creating artificial capital. And as long as that happens, these asset bubbles will continue to inflate. And as long as that happens, money, real capital, will not get to the real economy, because it's choosing to go somewhere else. It's choosing to go into the quick returns instead of the long-term, more stable returns. So you won't see as much inflation from that perspective, but you will see inflation, I think, as counties, as cities, as states, as countries have to deal with the services that they provide as a nation, and where they look at their funding and where they have to look at their budgets. All of a sudden taxes aren't coming in from places that are closed. And that's aside from, having sort of moved them forward. Taxes aren't coming in necessarily from companies, and a lot of them don't pay their taxes anyway and haven't forever, haven't for years, the larger companies. But they're also, sort of not paying as much now. They're not making as much money now. They're taking on more debt. So they're, so there's accounting games in that between the debt they take on to the taxes they're going to pay, and they still have a lot of their profits offshore. So money's not coming into the system at many, many levels now, from local up to federal, and that's going to sort of manifest in how services and how taxes go up. Like I know, for example, that I've been reading that certain utilities are expected to go up in the second half of this year and into next year. Those are sort of basic costs of things like electricity and communications and so forth, just to make up for some of the shortfall in the lack of or less demand, because less businesses are operating. And so we're going to see inflation and cost in that manner. Not necessarily in the standard sort of CPI type figures as they've been calibrated, for decades. That I personally think should be changed. But so we will see inflation, but not classical inflation. And that kind of inflation that we will see, that I'm talking about, I think is going to be more devastating to the Main Street economy and to small businesses and individuals, because it will be inflation that's felt in their necessary activities and the things and their basic needs.
That's interesting. That is interesting. Your take on that. You're not going to get the inflation into the commodities, but as long as this is going and it's quick money, it goes into the financial markets, to the stock market, to the bond market. Will the bond market get some of this as well?
Well, yes, and it is. I mean, we've seen, for example, in junk bonds and in high yield bonds, for a minute they traded off big time relative to the more investment grade bonds, on the expectation that if you have shutdowns and slowdowns, acutely and then sort of moving forward, that it's better to be in higher quality names. Now, I personally think it's always better to be in higher quality names, because if you're going to invest in corporations and in debt, you should want them to be in a position where they can repay it, or at least have the ability to have cash on the side where if they had to repay some of it, they could. But I do think that the capital markets, especially when they're fed very cheap electronically created money, and put on top of that all of these QE programs, which the Fed talks about its facilities, the 11 facilities it's put on board, some reopened, some new, since the coronavirus pandemic crisis began. Those facilities, which the Fed continues to characterize as lending, not spending, it doesn't really matter what you call it. You're basically, and the Fed is infusing money into commercial mortgage-backed securities, where a lot of commercial properties are going to, be dealing with closures of businesses or slowdowns or inability to sort of pay rent or leases for those properties by small mom and pops up through medium size, up through, international types of companies. And then, you put all of that together. And you continue to see that financial assets will be a place where that quick money will go. But again, some of that money will also, and some of the savings money will also go to certain commodities for that more permanent, more rid of uncertainty type of factor, like gold, like silver, as a diversification, as well as an uncertainty hedge.
So you don't think real estate's going to do all that well because of all this implosion of business, rents, particularly commercial business. There's restaurants here that have been open since the 70s that said, sorry, we're throwing in the towel, we're done. And that's a big black hole in a building where they're not going to rent it. And so you think that real estate, particularly commercial rents, commercial business, I don't see how you have a good residential real estate market if the commercial market is tanking. You think real estate's going to take a hit?
I do. I actually think commercial real estate, though, will take that larger hit. You look at large companies, for example, like Microsoft, right, who's now decided to permanently close, right? They are permanently moving from, some of their products being sold physically through their stores to a permanent closure of all their stores. I don't think they're the only company that's going to think that. You're going to have these companies on a large basis because they're being sort of strategic about what they feel they can get, they can do in terms of repositioning their models. And then you have the smaller restaurants, like you said. I mean, there are iconic restaurants for everyone, in this country, in the major cities as well as the smaller towns. We can pick your level, that don't have the ability, whether with a loan or not with a loan, to really get through this period. And in those cases, a lot of restaurants, bars, and so forth, it's just to be open is a cost. And then if you're half staff, I mean, if you're half visitors, half guests, half patrons, it doesn't always make sense to even keep, the minimal amount of staff to do that. So I think a lot of the rents for those mom and pops will not get paid or will have to be lowered, which means that the commercial property owners that had a stake in small towns or in malls throughout the country, which were already not doing very well before this period, are going to see some real problems. Now, you'll have bottom feeders, right? You'll have private equity firms coming in and restructuring commercial mortgage debt. Again, the Fed's buying commercial mortgage debt, and securitizations that have been created from commercial mortgage loans and so forth. So you'll have, that sort of rebalance that always happens when there's cash on the side. It's looking for, some form of place to hopefully grow itself from its perspective. But I do think commercial properties will really suffer, and so will commercial property owners. And I also think that from a residency standpoint, residential properties, I think it's going to be tougher for many people to pay rents if one or two or more people in a household are either not working for a longer period of time or working for less money or less hours, and therefore less money, or there's multiple people in that household undergoing the same thing. It's harder to pay rent. So that hurts residential owners. But in terms of individuals buying residential property, I think to an extent for people with money on the side, because rates are so low for mortgages, that there could be a shift in where people buy residential properties, like away from the cities. I think people are going for more of a premium on space and being able to work from home if they have that luxury, and not necessarily having to pay the higher prices for acquiring new property or a home, or the rents, let's say, are inherent to the larger cities. And I think that's going to be a permanent shift. I really do, because I think the generation that's coming, that's had to deal with like one or two crises in their sort of period on this earth, are going to be balancing, what's important. And if you have companies like Google, saying, look, you don't have to work on campus anymore. and and Facebook and so forth and Twitter. You have a real choice in where you live. And how cheaply you can cover your cost of living and your potential purchase of a home at these low levels, which I think is going to create a real change, not just in the United States, although I think more in the United States, because we've had higher unemployment levels and we've had more people out of work on a per capita basis. But I think generally that's going to be something that happens throughout the world. If we don't have to commute and we can be outside of a city and pay less to live, and have a better quality of life from that perspective, that's a major shift. And that's actually potentially, not great for cities, but potentially a positive shift ultimately for people.
Is this part of how people make it? My question is always for the little guy is, how does the little guy make it? You're looking at this field now, you've got this big picture, this global picture, this a permanent distortion. I love that term. But how does the little guy, the average guy, what should they be doing? Just a few pointers off the top of your head.
Yeah, I mean, I think some things that the average person should be doing, they probably have had imposed upon them. Some might have been doing this all along, but I think getting very clear on what's important to spend money on. And how to sort of recalibrate, outgoing expenses, whether people have been able to maintain their former level of money coming in or not. And obviously some people have had to do this, and some people, even if they haven't, should look at this. And some people have had to, should do it even more if possible, is to just reduce things that are not needed. I've always, it's always good to have less debt. And buy more on cash or on money, and have less of a debt footprint, and make those choices, as you sort of go along. Because I think that means that when we have these crises periods, you just have more of a cushion. And I think with this particular crisis and the shutdown and lockdown elements of it that we've seen is that cushion, cash, and a reduction of unnecessary expenditures is really important. That's not to say not to live life happily. It just means sort of making more choices from an economic standpoint, not just in this current period where everything seems very, very sort of new and visceral from the standpoint of the pandemic just having occurred in the last few months, but to use this also going forward and just to make it more of a permanent thing. And I think also from a standpoint of investing. And I've said this before, but it's, if you do have money on the side, it is a really good idea to invest in what you can use or what can store wealth, because you just don't know when another crisis is going to happen. And even if it doesn't, you get more of a financially confident, financially secure feeling by having that nest egg. One of the things I look at a lot in general is how squirrels do this. I'm a big fan of watching squirrels. It's fascinating to me. And I started It Takes a Pillage, comparing squirrel behavior to sort of traders on Wall Street, and I sort of gave it to the squirrels. But they have this innate ability to find food and get very innovative on what they need right now, whether that's working with one lone squirrel trying to bat it like a bird feeder and try to get stuff at the bottom and then sort of eat then, or put it somewhere in the corner of a yard or wherever the squirrels go to save for later, and sort of balance it out that way. And if it's one squirrel that needs to do it individually, they'll figure out a way. They'll hang upside down by their tails and sort of bat the bird feeder. If it's two squirrels, they'll work together. But they have this innate ability, it seems, to preserve their current stability, their current intake of food, but also save some that's going to be around and last for when they don't have a place to get it from. And I just think that's a really good motto to have for people, is to sort of in that respect think like squirrels. Invest in things that store wealth and can grow, like gold, like silver. Have cash on the side, have a reserve. Reduce expenses, even if it's hard, because that just gives you more of a solid foundation for next time.
Charles Netter used to work at Goldman. He thinks we're going to 5,000. He called the top of this market about 2%. So did Bull Pony. Both of them were right on time. Top of the market, and then it went down, and then it came back. They said it was going to go down. Both of them said the exact same thing. They came at it a different way. They said it was going to go around 35 to 40%. We got 38%. Wow. They're also both saying there's another big crash coming. Are you of the same mind that there is going to be yet another big and bigger calamity, financial calamity coming with all this massive money printing?
Oh yeah, no, I absolutely do. I mean, I thought so last time around, and I think this time my concern is that it, like you said, it will be bigger. Because every time we rise, and when I say we, I mean the elevation of manufactured money that's in the markets, driving them up artificially. We all know that if the Fed hadn't stepped in, right, and doubled their balance sheet and created all these facilities, and other central banks around the world, so we're doing similar things at a similar time, we wouldn't have had the recovery in financial markets, in the stock market in particular, that we had so quick. So the Dow had its best quarter since 1987. The NASDAQ had its best quarter since 1999. Now, yes, that was coming off, a sort of downfall in the prior quarter from respective equities. But, these are things that mean that we are continuing to drive up asset bubbles where we don't have the real economy to back it up. And the more that, I'll say it again, the more that sort of permanent distortion gets bigger, the more likelihood that the next crisis, which will inevitably happen, will be from a higher height. It will be from, a larger bubble, a bigger snowball, accelerating downward more quickly. I don't actually think we're out of this particular crisis mode. I mean, I think the markets, even with all that stimulus, are going to have a bumpy ride as the economy has a bumpier ride. But I do think that ultimately, if we get to a point where there's some recovery economically and whatever the stock market's doing at that time and the bond market's doing at that time, financially speaking, we have bigger bubbles. We just do. And therefore, when they pop with more vengeance. And that creates a larger crisis.
And you would be not that you are giving financial advice, I know you're not, but you would feel comfortable holding on to gold and silver right here, right now, right? 75 and $18 an ounce or whatever. You would feel comfortable holding hard assets.
No, I absolutely do, because I think that hard assets, in general, are a good diversification to all the sort of financial infusion that comes into markets, and does in fact, obviously, push up equity prices and bond prices. But I think that fact that these hard assets, and yes, gold has rallied, but I mean, I think it has much more to rally, and silver kind of hasn't had its rally. And part of that is because on the flip side of silver, you have more use values for silver in product development, and certain products have sort of come down because of the economic slowdown. So silver has a kind of different path. But as we saw in the wake of the financial crisis of 2008, these commodities, gold and silver, have the ability to go up quite substantially as the Fed's book increases in size, which we know it's going to do. We've been told that. Multiple times in many different words by Federal Reserve Chairman Jerome Powell.
Yeah, well, it's almost like a no-brainer. It's just like, hey, folks, we're going to inflate our book, and gold goes up with our book, so it's going to happen, right?
It is going to happen, and gold will do that. Gold has started to do that, as I said before, in the first phase of that, of the initial growth of the Fed's balance sheet, but there will be another phase. We know this, and it could creep up, or it could be in chunks, depending on what happens out in the real world, what happens economically, what happens from the standpoint of this virus or any sort of knock-on effects. So whether the Fed sort of grows its book instantly by a lot, or in smaller amounts towards that $10 trillion amount that Bill Dudley talked about, it's still growing. And as a result, gold will grow with that. Silver will have some more volatile moments, as it always does relative to gold. But I mean, it is cheaper to begin with. And to that extent that it follows the Fed's book growth, it can have a really good upside from a more affordable level. So both of those two things.
I know you don't have a working title for your book, but I love the permanent distortion thing. I just love it. I mean, it's just the way you lay it out and how, all this money and it's cheaper and it's faster and it's easier and they're going to grow their balance sheet and they're telling us they're going to grow their balance sheet. I mean, this is all part of your book. Is gold going to be a part of of this book that's coming out? What, next year? I take it.
Yeah.
All this is just a little smattering of what you work on, what's going through your head. I mean, your books are just you get your money's worth on. This is collusion, right? And I was looking at trying to find the last page of the book where you were talking about the coming problem, and I'm thinking, oh yeah, I forgot. Here are all the references just for. I don't even think I have them all. It's like 100 pages of references. I don't even have them all, but it's at least this much, and there's some more I don't have. I mean, and it's the same with all the president's bankers. You put so much into these books. I mean, they take, you travel, you go all over the world, you have this global perspective. So thank you this is a treat. You basically give us kind of a little preview of your book, which are huge. I mean, look at this, all the president's bankers. I mean, this is not like a weekend book. This is like a 5 or 6 or 7 weekend book. But anyway, thank you very much for joining us on USA Watchdog. Your website, NomiPrins.com. I'm sure you'll be giving us updates on when this book's going to come out sometime in 2021. I know they've backed up some books.
Yeah,
things like that. But thank you so much for coming on and giving us your perspective. You have a huge brain, and you're a 3-time best-selling author. And thank you for sharing your thoughts and your analysis about the markets on USAWatchdog.com. Nomi Prins, thanks for joining us today.
Thank you so much.